Could political decisions undermine what was once considered a secure revenue stream in commercial real estate? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a surprising move this spring, Elon Musk's Department of Government Efficiency, DOGE, shook the commercial real estate market by initiating the largest wave of federal lease terminations in United States history. Agencies such as the Internal Revenue Service and the Department of Education vacated their offices abruptly, leaving landlords to face sudden income losses. Historically, federal leases have been considered some of the safest in commercial real estate, thanks to their average 14-year terms and reliable payments. However, DOGE's decision to exercise early termination options that had rarely been used before, has injected a new level of uncertainty into what was previously seen as a near risk-free investment. A study co-authored by Cameron LaPointe, an assistant professor of finance at Yale School of Management, reveals that these cancellations have driven up the cost of commercial mortgage-backed securities as investors began to price in more risk. This could have broader economic implications. LaPointe, along with Soon-Hyok Choi from the Rochester Institute of Technology, found that landlords in the Washington, D.C. area experienced a roughly 5% decline in net operating income within a few months, consequently driving down property values. The impact was particularly pronounced on junk-rated commercial mortgage-backed securities tied to leases that were listed for termination, which dropped about 4% more than securities linked to government properties that had not been targeted. This indicates a rapid recalibration by investors in how they value federal lease-backed debt. The study also identified a spillover effect, with nearby properties suffering financial declines despite not being directly tied to the canceled leases. Using their model, LaPointe and Choi estimate that DOGE's actions could erase up to $575 million in value from the DC commercial office market over the next 5 years, along with $50 million in lost property tax revenue. For property owners already grappling with hybrid work models and elevated vacancy rates, this federal retreat has magnified existing pressures on balance sheets. The findings underscore a new risk factor for the wider commercial real estate industry. Political decisions can rapidly destabilize even the most secure-seeming revenue streams. If government leases, long viewed as bulletproof collateral, can be terminated en masse, investors and lenders will need to incorporate political volatility into their pricing models alongside traditional credit and market risk. This repricing of government-backed debt could also spill over into broader credit markets, particularly affecting regional banks already exposed to struggling office assets. For landlords and cities, the message is clear: diversify tenant bases and reduce reliance on federal occupancy as a cornerstone of downtown economies. What happens in Washington could reshape risk assumptions across the entire commercial property landscape, making it crucial to adapt to these evolving dynamics. Commercial real estate stocks surged Friday after Federal Reserve Chair Jerome Powell signaled that interest rates could soon move lower, boosting hopes for relief in a sector weighed down by refinancing risks and sluggish deal activity. In a closely watched speech, Mr. Powell said, "Policy is in restrictive territory, and that the shifting balance of risks may warrant adjusting our policy stance." Markets took the remarks as an indication that the central bank may cut rates later this year. The Real Estate Select Sector SPDR Exchange-Traded Fund, which tracks listed property companies, rose 2% on pace for its strongest advance since April. Gains were broad-based across office, retail, and industrial landlords. Office real estate investment trusts rebounded, with office owners, among the hardest hit by higher vacancies and steep borrowing costs, rallying sharply. SL Green Realty, the largest office landlord in Manhattan, gained more than 6%, while Boston Properties rose nearly 5%. Analysts said lower financing costs could help ease pressure on balance sheets and stem the slide in valuations. Retail landlords also climbed, with Simon Property Group advancing 4%. Industrial giant Prologis added 3.5% as investors bet that cheaper debt could unlock new development pipelines for logistics facilities and warehouses, which remain in demand from e-commerce tenants. Developers with large project pipelines and real estate brokerages extended the rally. Anywhere real estate climbed 7%, re/max. Holdings surged 8.1%, and Zillow rose 5.9%. Mortgage lenders and servicers also gained, with Rocket companies up 9.1% after announcing a deal to acquire Mr. Cooper Group, which advanced 7.8%. The prospect of lower rates is particularly critical for real estate investment trusts, many of which face billions in debt maturities over the next 2 years. A modest decline in financing costs could ease refinancing risks, revive transaction activity, and allow stalled office to residential conversions and multifamily projects to move forward. As of Thursday, the average 30-year fixed mortgage stood at 6.58%. While not directly tied to the Federal Reserve's benchmark, mortgage rates typically move in tandem. For property developers and listed landlords, Powell's comments offered the first signal in months that relief from restrictive policy may be on the horizon. Bridge 33 Capital has successfully secured a substantial $460 million commercial mortgage-backed securities loan to refinance its retail portfolio, which spans both the Sunbelt and Midwest regions. This development marks a significant financial maneuver for the company, as reported by Anthony Russo in the Commercial Observer. The financing was arranged with Wells Fargo, featuring a floating interest-only rate, and includes a 2-year term with options for 3 one-year extensions. This portfolio encompasses 12 properties situated across 9 states: Georgia, Maryland, Nevada, Illinois, Colorado, South Carolina, Michigan, Indiana, and Texas. Impressively, the assets are 91.4% occupied by 260 tenants, including major retailers like Dick's Sporting Goods and TJX Companies, both of which contribute over 5% of the base rents in the 4.1 million square foot portfolio. Bridge 33 Capital has demonstrated an aggressive acquisition strategy in the retail sector this year. The firm has announced 4 significant acquisitions, including a 374,753 square foot property in Columbia, South Carolina, a 448,000 square foot open-air center in Grand Rapids, a 175,000 square foot asset in Loganville, Georgia, and a 438,401 square foot shopping center in Rockford, Illinois. Since its inception in 2012, Bridge 33 Capital has acquired 51 commercial properties. Despite the uncertainties introduced by tariffs imposed by the Trump administration, retail spending remains robust. A recent Colliers analysis highlighted a 4.3% year-over-year increase in sales for July, fueled by events like the 4th of July, back-to-school shopping, and Prime Day deals. However, the analysis also cautioned that consumers are preparing for potential economic shocks, signaling possible challenges ahead for the retail sector. Industrial buildings in Charlotte are increasingly part of the flight to quality trend, which was previously associated mainly with office spaces. According to a recent report, this trend is gaining traction in the industrial and warehousing sectors. Companies are now opting for new, state-of-the-art facilities that offer modern amenities such as higher ceilings and advanced infrastructure, leaving older properties behind. Trinity Capital has taken a notable step in this direction by purchasing a 17.2-acre parcel at 2241 Graham Park Drive. They plan to develop Graham Park CLT, a cutting-edge industrial building designed to accommodate various size requirements, reflecting the current market demand. The facility will span 172,000 square feet and feature 32-foot clear heights, providing the kind of modern amenities that are attracting tenants today. This shift in tenant preferences towards higher quality industrial spaces mirrors what has been observed in office real estate. As more businesses prioritize modern facilities, the demand for older properties is waning, pushing developers and investors to revitalize their portfolios with new constructions or extensive renovations. This trend is not just limited to Charlotte, but is also being observed in other major markets across North America. Construction has commenced on a $15.5 million project aimed at transforming the historic Farm and Home Savings and Loan Association building in downtown St. Louis into a modern mixed-use facility. This redevelopment, spearheaded by Blackline Design and Construction, will see the landmark structure at 1001 Locust Street converted into 60 residential apartments, along with commercial space on the ground floor. The project is indicative of a broader trend in urban centers, where older office buildings are being repurposed to meet the demand for residential units, while still maintaining commercial viability. This initiative aligns with a growing movement across North America, where cities are increasingly looking to revitalize their downtown areas by repurposing outdated office spaces. In Kitchener-Waterloo, Ontario, similar efforts are underway to convert aging office infrastructure into vibrant living spaces, reflecting a shift in urban planning priorities towards more sustainable and community-focused developments. Such conversions not only breathe new life into historic buildings, but also contribute to the economic rejuvenation of city centers. On the American side, cities like St. Louis are embracing these changes to address the evolving needs of their populations. The transformation of the Farm and Home Savings and Loan Association building is expected to enhance the local real estate market by providing much-needed housing options while preserving the architectural heritage of downtown. This project underscores the potential for adaptive reuse projects to foster economic growth, attract new residents, and create a dynamic urban environment. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.